On December 17, 2025, the final nail was driven into the coffin of the once glamorous $5 billion salad empire known as Sweetgreen. It was not just another bad earnings report or a simple dip in the market. It was a total admission of failure from the men who promised to revolutionize how the modern world eats. For years, investors were told that kale and quinoa could be scaled with the same explosive growth as a Silicon Valley software company, but today, that dream is officially dead. The stock has plummeted over 80% this year alone, reaching levels that suggest the market is preparing for a complete and final liquidation of the brand. As we look at the financial wreckage of late 2025, it is clear that the $18 salad was never a sustainable business model for the masses. To understand why Sweetgreen is officially over, you have to look past the beautiful minimalist store designs and the celebrity endorsements that once filled our feeds. You have to analyze the cold, hard numbers that prove this company was burning through venture capital cash faster than they could even chop their organic vegetables. While competitors like Chipotle and Cava found a strategic way to thrive in a high-inflation world, Sweetgreen doubled down on a luxury pricing strategy that eventually alienated its most loyal urban customers. This is not just a story about expensive lunch options. It is a financial autopsy of a corporate identity crisis that combined tech bro arrogance with fundamental retail incompetence. In this deep dive, we are going to explore the secret financial reports and the failed robotic experiments that turned the multi-billion-dollar dream into a penny stock nightmare. The Sweetgreen story began back in 2007 when 3 Georgetown graduates decided that the world needed a fast food version of a farmer's market. At the time, their vision was actually quite noble and filled a massive gap in the market for healthy, convenient meals that did not feel like a compromise. They successfully built a brand that was as much a cultural phenomenon as it was a restaurant, even launching massive music festivals to blend food with lifestyle marketing. For a while, the strategy worked perfectly because they were operating in an era of cheap money where growth was valued far more than actual profitability. They were able to expand into the most expensive real estate in the country because investors were willing to subsidize every bowl of kale they sold to the public. By the time Sweetgreen decided to go public in late 2021, the company had successfully convinced Wall Street that they were a technology company that just happened to sell salads. This was a critical part of their financial angle because technology companies receive much higher valuation, multiples than traditional restaurant chains. On their first day of trading, the stock price nearly doubled, and the founders were suddenly sitting on a company worth over $5 billion, despite never having made a single penny in profit. This massive valuation was built on the assumption that they could use data and mobile apps to dominate the lunch hour of every white-collar worker in America. However, the founders failed to realize that the digital infrastructure they built was extremely expensive to maintain and offered very little protection against rising food costs. The core of the Sweetgreen failure lies in what economists call the value perception gap, which became a terminal illness for the brand in 2025. When you charge $18 for a salad that consists mostly of water-heavy greens and a few ounces of protein, you are operating on a very thin margin of customer patience. In the early days, customers were willing to pay a premium for the status and the sleek app experience that Sweetgreen offered. But as inflation began to bite into the average American's disposable income, the luxury of a $20 lunch became the first thing people cut from their daily budget. Sweetgreen found themselves trapped in a high-priced corner with no way to lower their costs without destroying the premium image they had spent a decade building. One of the most devastating financial mistakes in the company, as history, was their obsession with replacing human workers with expensive robotic kitchens. In a desperate attempt to fix their terrible operating margins, they spent nearly $70 million to acquire a robotic startup called Spice. The plan was to build what they call infinite kitchens, where automated assembly lines would prepare salads faster and more accurately than any human could. But the reality of maintaining complex machinery in a high-volume food environment proved to be a capital expenditure nightmare that drained their remaining cash reserves. By November of 2025, They were forced to sell off this technology to a company called Wonder in a fire sale that signaled the end of their automated dreams. The financial data from the most recent quarter reveals a company that is essentially a zombie, kept alive only by the remnants of its IPO cash and desperate cost-cutting measures. Their same-store sales have cratered as the return-to-office movement stalled out in major cities like New York and San Francisco. Sweetgreen had bet their entire future on the idea that urban office workers would always be willing to pay a premium for a convenient, healthy lunch. When the workforce shifted to hybrid and remote models, the massive rent Sweetgreen was paying for their flagship urban locations became a noose around their neck. They are now stuck with long-term leases on expensive real estate that no longer sees the foot traffic required to break even on a daily basis. In a move that many analysts saw as the ultimate sign of desperation, Sweetgreen recently tried to pivot towards selling French fries and other fast food staples to drive traffic. This was a total betrayal of their health-focused roots and signaled to the market that the management team had completely run out of ideas to save the core business. You cannot spend 15 years telling the world you are the future of health, and then try to save your stock price by selling avocado oil fries to a skeptical audience. This experimental menu change cost millions in operational adjustments and only served to confuse the loyal customers who actually liked the original mission. It was a classic example of a brand losing its soul in a frantic attempt to satisfy a disappointed Wall Street. The competition in the fast casual space has also played a major role in Sweetgreen's official collapse as other brands learn from their mistakes. Companies like Cava and Chipotle have managed to offer a similar level of quality and convenience at a price point that is significantly lower and more accessible to the middle class. While Sweetgreen was focused on being a tech-forward luxury brand, their competitors were focused on operational efficiency and supply chain management. This allowed them to scale much faster and reach a level of profitability that Sweetgreen could only dream of achieving. In the world of finance, if you cannot prove that your business model works at scale, the market will eventually move on to the next winner who can. The final blow came on December 17th when Nathaniel Ru, one of the original co-founders and a key architect of the brand's identity, announced his official retirement. This departure triggered a massive sell-off as investors realized that the original leadership team was finally jumping ship before the company hit bottom. When the people who built the company no longer believe in its path to recovery, there's very little reason for the public to keep their money in the stock. We are currently seeing a mass exodus of institutional investors who are tired of waiting for a profit that has been promised for over 4 years but never delivered. The dream of the $5 billion salad has officially turned into a cautionary tale of corporate greed and poor financial planning. Looking forward to 2026, the most likely outcome for Sweetgreen is either a hostile takeover by a larger private equity firm or a total restructuring under bankruptcy protection. The brand itself still has some value, but the current corporate structure and debt load are completely unsustainable for the revenue they are generating. They will likely be forced to close dozens of underperforming stores and retreat back to a few core urban markets where they can actually turn a small profit. The era of the hyper-growth salad chain is over, and what remains will be a much smaller, leaner version of what was once promised to the world. It is a harsh reminder that in the end, the fundamental laws of economics will always win over hype and high-tech marketing. The story of Sweetgreen serves as a warning to every other premium brand that thinks they can ignore the importance of value and operational discipline. You cannot build a lasting empire on the backs of customers who are feeling the squeeze of a changing economic reality. As the $18 salad officially becomes a relic of a past financial era, we have to ask ourselves what other overvalued dreams are waiting to collapse next. The market has no mercy for companies that lose sight of their customers while chasing a software-level valuation that they never earned. Sweetgreen's collapse is not just about a restaurant. It is about the end of an era where style was valued more than substance in the eyes of Wall Street. As we close the book on this multi-billion-dollar disaster, the lessons for entrepreneurs and investors alike are very clear and very painful. Focus on the unit economics from day one, and never let the allure of high-tech labels distract you from the reality of your product. If your business model requires $18 for a bowl of leaves just to break even, you don't have a revolutionary company. You have a luxury hobby that the market will eventually reject. Thank you for following this deep dive into the official end of the Sweetgreen dream and the financial reality of 2025. We will continue to track the final days of this corporate giant as they navigate the fallout of their own failed ambitions.